2026 is shaping up to be one of the most disruptive years in Canadian real estate. And the 2025 data is flashing warning signs everywhere. Let me explain. We're talking about 1.8 million mortgages renewing by mid-2026. 73% are uninsured. And right here in the GTA, the home prices have gone down 5 to 7% in 2025. And as we all know, the inventory keeps rising, and even with the Bank of Canada rate cuts releasing pressure on variable rate mortgages, we are starting to witness fixed rates going up in December. Most Canadians have no idea how big this shift is. But in the next few minutes, you will, because this video breaks down exact data, official Bank of Canada research, and what it all means for 2026 buyers and sellers. This is my opinion and my 2026 predictions. And here's what we are breaking down today. The most important 2025 data. How many mortgages renew in 2026 and who are at risk? Insured versus uninsured mortgages and why it matters. What interest rates and bond yields tells us, what 2026 means for buyers, what 2026 means for sellers, and my full prediction for how the market behaves next year. So let's unpack 2026. This is why 2026 isn't guesswork. It's not speculation. It's not opinions. It is strictly data driven. We already know when lower rate mortgages expire, how many renew, how many are uninsured, how home prices shifted in 2025, and also how the inventories changed and how rates and bond markets responded. This is why 2026 is predictable and for some homeowners uncomfortable. Let's start with the biggest factor, the mortgage renewal wave. According to the Bank of Canada and BMO, about 1.8 million mortgages will renew over the next 12 months, with the peak being June 2026. Most of these people locked in mortgages around 1.5 to 2% way back in 2021. Today, even after rate cuts, most fixed rate mortgages are hovering around 4%. That's a large payment shock, but it gets more interesting. The updated Bank of Canada analysis from July 2025 showed 60% of mortgages renewing in 2025, and 2026 will see higher payments even after major rate cuts. Most of those affected are 5-year fixed borrowers coming off of 2021 lows. This is where the risk becomes clearer. In 2016, only 47% of bank mortgages were uninsured. Today, 73% are uninsured. So why does this matter? Because uninsured mortgages have no CMHC protection. If a borrower can't renew, the bank carries the loss risk. And banks do not like risk. That is why banks will enforce higher income verification, require stronger ratios, push for higher payments, and ultimately encourage selling if needed. This is one of the biggest reasons 2026 will see more listings, not because people want to move, but because some must. Let's talk about what actually happened in 2025. In the GTA market, prices fell 5 to 7% year over year. The home price index dropped 5 to 6%. New listings spiked. Days on the market lengthened. Borrowers gained the advantage. In Oakville and Burlington, the same thing happened. More listings, longer days on market, pickier buyers, especially in the $1 million to $1.5 million detached category. This matters because falling prices and rising inventory plus renewal pressure equals a softer first half of 2026. Let's make interest rates simple. The Bank of Canada started cutting rates aggressively in 2024 from 5% and now 2025 to 2.25%. But on December 10, 2025, the Bank of Canada held the rates unchanged. This pause tells us the big cuts are over. The bank is very cautious. But here's what most people misunderstand. Fixed mortgage rates don't follow the Bank of Canada, they follow the bond market. And in December 2025, the 5-year bond yield jumped up above 3%, pushing fixed rate mortgages up. This is why affordability didn't improve, as expected. Here's the simple 2026 outlook. Variable rates likely flat or slightly down. Fixed rates will bounce around depending on the global yields. Here is my prediction for 2026 based on everything we've seen so far. Prices soften early in 2026, then stabilize. Not a crash, but a slow grind in high inventory markets. The listings will continue to increase. Renewals will force some owners, especially 2021 buyers and investors, to sell. Best buyer window in years. If your income is stable, 2026 gives you the leverage you haven't seen since 2019. A split market emerges. Stressed sellers feel the pain. Prepared buyers will capitalize. So, what does this mean for buyers? 2026 might finally be the year the math works again for buyers. Here's what you will see. More inventory, more negotiation room, more conditional offers, fewer bidding wars. Prices that are stable or slightly lower. If you've been waiting, renting, or feeling priced out, 2026 might be your best window before the next cycle begins. And what does this mean for sellers? Sellers, 2026 requires strategy. You cannot test high prices. You must forget the past. You must align with the data. To sell successfully, you need sharp pricing, strong staging, professional marketing, and move-in ready presentation. Gotta also be flexible. You can get a strong sale price, but you cannot ignore the market realities. So here's the bottom line. 2026 will be a year of pressure for some homeowners and a year of opportunity for buyers who are prepared. Every neighborhood in Oakville, Burlington, and the GTA behaves differently. And the winners will be people who make data-driven decisions, work with someone who understands the local market. If you're planning to buy or sell, whether in 60 days or 6 months, reach out to me. My number is below. I'll show you exactly how these trends apply to your specific situation. And thanks for watching. I'm Realtor Roshan, and I'll see you on my next video.